The financial world is witnessing something unprecedented right now. For decades, the US dollar has been the undisputed king of global finance. Every major commodity, from oil to gold, has been priced in dollars. Every central bank has held dollars as their primary reserve. But that monopoly is facing its first serious challenge in generations. The BRICS nations, Brazil, Russia, India, China, and South Africa, are moving toward creating a gold-backed currency that could fundamentally reshape how international trade works. And if you think this is just political posturing, you need to look at what's actually happening behind the scenes. Let me be clear about something from the start. This isn't about conspiracy theories or doomsday predictions. This is about recognizing a genuine shift in the global monetary system that's already underway. The question isn't whether BRICS countries want to reduce dollar dependency. They've stated that explicitly. The question is whether they can actually pull it off, and what that means for your investments, for gold prices, for silver markets, and for the entire structure of international finance. So what exactly are we talking about when we say a BRICS gold-backed currency? The proposal that's been circulating involves creating a new settlement unit for trade between BRICS nations that would be partially backed by gold reserves. This isn't a replacement for domestic currencies like the yuan or the rupee. Instead, it's a mechanism for countries to trade with each other without converting everything through dollars first. Think of it as a parallel system running alongside the current dollar-dominated framework. Now, why does this matter? Every time a Brazilian company wants to buy Indian manufactured goods, the current system requires converting Brazilian reals to US dollars, then dollars to Indian rupees. The US dollar sits in the middle of almost every international transaction, even when America has nothing to do with the trade. This gives the United States enormous financial leverage. When the US imposes sanctions, it can effectively cut countries off from the global financial system. When the Federal Reserve raises interest rates, emerging markets feel the pain immediately because so much of their debt is denominated in dollars. Russia learned this lesson the hard way after 2022 sanctions froze hundreds of billions in dollar reserves. China has watched nervously, knowing that similar measures could be deployed against them over Taiwan or trade disputes. India, despite being a democracy, resents having its monetary policy essentially dictated by Federal Reserve decisions. These aren't minor grievances. These are existential concerns for major economies that collectively represent over 40% of the world's population and a quarter of global GDP. The gold backing element is crucial here. Fiat currencies like the dollar derive their value from government decree and economic strength. But historically, gold has been the ultimate store of value, the one asset that maintains purchasing power across centuries and empires. By tying their proposed currency to gold, BRICS nations are attempting to create something that has intrinsic value, something that can't be printed into oblivion by a central bank, something that offers stability independent of any single nation's policies. Let's talk about the mechanics. Based on discussions at recent BRICS summits, the proposal involves member nations contributing gold reserves to a common pool. This gold would then back a digital settlement unit. Let's call it the BRICS unit, that countries could use for bilateral and multilateral trade. If Brazil wants to buy Chinese electronics, instead of dollars, they'd settle in BRICS units. The exchange rate would be tied to the weight of gold backing each unit, providing stability and transparency. Now, here's where it gets interesting for precious metals investors. If this system actually launches and gains traction, the demand for physical gold would surge dramatically. We're not talking about modest increases. We're talking about potentially thousands of tons of gold being allocated specifically to back this new monetary system. The BRICS nations already hold substantial gold reserves. China alone has been steadily accumulating gold for years. Russia has massively increased its holdings, and India is the world's second-largest consumer of gold. But supporting a new currency system would require significantly more. The Silver Institute and various commodities analysts have pointed out that silver could benefit even more dramatically. Here's why. Gold is expensive and dense. A little goes a long way in terms of value. But for smaller transactions and broader monetary circulation, you need a more divisible metal. Historically, silver has filled that role. If BRICS nations move toward any form of precious metals backing for broader monetary instruments beyond just settlement between governments, silver demand could explode. We've already seen silver prices move from around $18 per ounce to peaks above $30 in recent months. Supply constraints in silver mining combined with industrial demand from solar panels and electronics create a perfect storm. But let's pump the brakes on pure speculation and look at the realistic challenges. First, getting 5 major nations with different political systems, economic priorities, and historical rivalries to actually coordinate on something this complex is extraordinarily difficult. China and India have border disputes. Russia's economy is under severe strain. Brazil's political situation shifts dramatically between administrations. Creating a unified monetary system requires trust, infrastructure, and ironclad agreements. That takes time and political will that may not survive the next election cycle in any of these countries. Second, the dollar's dominance isn't just about government preference. It's embedded in the infrastructure of global finance. Banks worldwide hold dollars. International contracts are written in dollars. The SWIFT system for transferring money operates primarily in dollars. Shipping companies, insurance providers, commodity exchanges, all of these have dollar-based systems that have been refined over decades. Building a parallel system that's actually functional and trustworthy enough for major corporations to use requires massive investment in financial infrastructure. Third, gold backing comes with serious limitations. One of the reasons nations abandoned the gold standard in the 20th century was because it restricted monetary flexibility. When your currency is tied to gold, you can't easily adjust money supply to respond to economic crises. You can't print money to stimulate a sluggish economy or provide emergency liquidity during a financial panic. The very stability that gold provides also creates rigidity. Modern economies need flexible monetary policy to function. A fully gold-backed currency would be incredibly restrictive. That's probably why the BRICS proposal is talking about partial backing or backing only for international settlement rather than full-fledged gold standard currencies. But even partial backing requires significant gold reserves and creates complications. What percentage of backing provides enough credibility without creating too much rigidity? How do you handle revaluation when gold prices fluctuate? These are complex questions without easy answers. Now, let's talk about what this means for the US dollar. The dollar's reserve currency status provides enormous benefits to the United States. The government can borrow money at lower interest rates because there's always global demand for dollar-denominated debt. American companies can operate internationally without currency risk. The U.S. essentially exports inflation to other countries because they need to hold dollars. Losing reserve currency status would be economically painful for America, potentially increasing borrowing costs, reducing the trade deficit capacity, and diminishing geopolitical influence. But here's the thing. Reserve currency status isn't binary. It's not all or nothing. The British pound was the dominant reserve currency for a century before gradually ceding that role to the dollar over several decades. The transition wasn't instant. Multiple reserve currencies can coexist. The euro represents about 20% of global reserves despite being only 25 years old. A BRICS currency could similarly carve out a portion of international settlements without immediately dethroning the dollar. The realistic scenario isn't dollar collapse. It's gradual dollar decline. If the BRICS currency successfully handles even 10 to 15% of international trade settlements, that's a significant shift. It would reduce dollar demand, potentially weaken the currency modestly, and force the U.S. to be more disciplined about fiscal and monetary policy because the captive audience for dollar-denominated debt would be smaller. For investors, this means diversification becomes even more critical. Let's examine specific market implications. Gold prices have already been climbing, reaching record highs recently above $2,100 per ounce. Part of that is inflation hedging, part is geopolitical uncertainty. But sustained central bank buying, particularly by BRICS nations, has been a major factor. If a gold-backed BRICS currency becomes reality, central bank gold purchases could accelerate dramatically. Historical patterns show that when central banks shift from selling to buying gold, prices can sustain elevated levels for years. For silver, the dynamics are even more compelling. Current silver prices around $30 per ounce are still well below the inflation-adjusted highs from the 1980s, which would be over $150 in today's dollars. Industrial demand continues growing, Solar panel production alone consumes about 20% of annual silver supply. Electric vehicles use significantly more silver than traditional cars. 5G infrastructure requires silver. If you add monetary demand from a BRICS precious metals system on top of existing industrial demand, and consider that silver mining production has been relatively flat, you have a classic supply-demand squeeze setting up. Some analysts, and I want to be clear this is speculative, have suggested silver could see moves toward 50, 70, or even higher in a scenario where precious metals regain significant monetary roles. The gold-to-silver ratio, currently around 70-1, historically averaged around 15-1. If that ratio were to revert toward historical norms while gold prices stay elevated, silver would need to appreciate substantially. Now, markets don't always revert to historical averages, and past performance doesn't guarantee future results. But the asymmetry in risk-reward for silver looks interesting from an investment perspective. Beyond precious metals, think about what this means for commodity markets broadly. Oil, natural gas, agricultural products, these are all currently priced in dollars. If major economies start settling trade in alternative currencies, we could see commodity prices diverge between dollar markets and BRICS markets. Arbitrage opportunities might emerge, but also price discovery could become more fragmented. For commodities traders and investors, this adds a new layer of complexity and potential opportunity. The geopolitical implications run even deeper. The dollar's reserve status has been a cornerstone of American power since World War II. It allows the U.S. to project military power globally because it can finance operations through debt that the world is eager to buy. It enables sanctions to be devastatingly effective. It makes America the center of global finance. A successful BRICS currency system would shift some of that power eastward. Not overnight, but gradually. We're talking about a potential realignment of the global order that could define the 21st century the way American dominance defined the 20th. Now, I want to address the skeptics, because there are legitimate reasons to doubt this will work. Previous attempts at creating alternative international monetary systems have largely failed. The euro succeeded within Europe, but hasn't significantly challenged the dollar globally. China launched the petro-yuan for oil trading years ago, and uptake has been modest. The inertia of the existing system is powerful. Network effects mean everyone uses dollars because everyone else uses dollars. Breaking that cycle requires not just a viable alternative, but compelling reasons for market participants to switch despite the hassle and risk. Moreover, the BRICS countries themselves have significant economic vulnerabilities. Russia's economy is heavily dependent on energy exports and has been hampered by sanctions and demographic decline. Brazil faces chronic inflation and political instability. South Africa has struggled with electricity shortages and economic stagnation. India, while growing rapidly, still has a massive population living in poverty and infrastructure challenges. China, despite its economic might, faces a property market crisis, demographic problems from decades of one-child policy, and mounting debt levels. These aren't the most stable foundations for a new monetary system. There's also the question of trust. Would international businesses and investors really trust a currency system controlled by governments with mixed records on transparency and property rights? The dollar benefits from America's deep capital markets, strong legal institutions, and relative political stability. Those aren't things you can replicate quickly. Building the kind of trust necessary for a reserve currency takes decades. So where does this leave us? The BRICS gold-backed currency proposal is real. It's being actively discussed, and there's genuine momentum behind it. But the path from proposal to functioning alternative monetary system is long and filled with obstacles. The most likely outcome isn't a dramatic overnight shift, but rather a gradual evolution toward a more multipolar monetary system where the dollar remains dominant but shares space with regional alternatives. For investors, this environment suggests several strategies. First, precious metals allocation makes sense as both an inflation hedge and a bet on changing monetary dynamics. Whether you prefer physical gold and silver, mining stocks, or ETFs, having exposure to precious metals in a portfolio looks prudent. How much depends on your risk tolerance and time horizon, but somewhere between 5 and 20% of a portfolio in precious metals isn't unreasonable in this environment. Second, diversification across currencies and geographies becomes more important. Don't have all your assets denominated in dollars or concentrated in dollar-dependent investments. Consider international stocks, particularly in countries with strong commodity bases or those likely to benefit from BRICS trade arrangements. Real assets like real estate, commodities, and infrastructure can provide protection if currency volatility increases. Third, stay informed and flexible. This situation is developing in real time. The next BRICS summit could announce concrete steps toward implementation, or the whole thing could stall out due to political disagreements. Federal Reserve policy changes, geopolitical events, commodity supply disruptions, all of these can shift the landscape quickly. Building a portfolio with some protective positions while maintaining flexibility to adjust is key. Fourth, think critically about information sources. There's a lot of hype and fear-mongering around these topics. Some people are predicting imminent dollar collapse and hyperinflation. Others dismiss any challenge to dollar dominance as fantasy. The truth is probably somewhere in the middle. Look for analysis backed by data, consider multiple perspectives, and be wary of anyone claiming certainty about complex geopolitical and economic dynamics. What should you be watching going forward? Several key indicators will tell us whether the BRICS currency is becoming real or remaining a pipe dream. First, watch for concrete technical announcements about the currency mechanism, how it will be structured, what the gold backing ratio will be, how transactions will be processed. Vague statements about cooperation are meaningless. Detailed technical specifications mean they're serious. Second, monitor central bank gold purchases. If BRICS nations suddenly ramp up gold buying significantly beyond current levels, that's a signal they're preparing to actually back a currency. Third, look for pilot programs or initial trade settlements using any new BRICS mechanism. The proof is in actual usage, not just announcements. Fourth, pay attention to which countries outside the original 5 BRICS nations show interest in joining or using the system. If major economies like Indonesia, Saudi Arabia, or Turkey start moving toward BRICS trade settlement, that's a game changer. The system's viability depends on network effects. The more countries use it, the more useful it becomes. Conversely, if uptake remains limited to just the original 5 members, the impact will be minimal. Fifth, watch commodity markets, particularly oil. If Saudi Arabia or other major oil exporters start accepting payment in BRICS currency for crude oil, that would be enormously significant. Oil has been priced in dollars for 50 years. Breaking the petrodollar system would be the clearest sign, yet that dollar dominance is genuinely threatened. Let me also address the timeline question, because that matters enormously for investment decisions. Even if everything goes perfectly for BRICS, we're talking years for implementation, not months. Currency systems require extensive infrastructure, payment networks, exchange mechanisms, legal frameworks, banking relationships. China has been working on its digital yuan for over a decade, and it's still not fully rolled out domestically. A multi-nation system is exponentially more complex. Realistically, we're looking at a 3 to 10-year time frame for any BRICS currency to go from proposal to meaningful usage in international trade, assuming it happens at all. That means this isn't about making panic moves in your portfolio today. It's about gradually positioning for a changing landscape over the next several years. Dollar assets aren't going to zero tomorrow. The U.S. economy remains the largest and most dynamic in the world. American capital markets are unmatched in depth and liquidity. But the trajectory points toward a less dollar-centric world, and adjusting portfolios accordingly makes sense. One aspect that doesn't get discussed enough is what this means for everyday people, not just investors. If the dollar weakens due to reduced reserve demand, import prices rise. Americans would pay more for electronics from China, cars from Europe, coffee from Brazil. On the flip side, American exports become more competitive, potentially boosting manufacturing jobs. The trade deficit might shrink. There are winners and losers in any major economic shift. For people living on fixed incomes or holding substantial cash savings, dollar weakness is problematic. For people with hard assets, real estate, or international income streams, it might be beneficial. There's also a generational aspect here. If you're in your 20s or 30s right now, the monetary system you deal with for most of your working life might look significantly different from what your parents experienced. The period of unchallenged dollar dominance could be looked back on as a specific historical era rather than a permanent state of affairs. Understanding these shifts and positioning accordingly could make an enormous difference in long-term wealth accumulation. Now, let's talk about the elephant in the room. What could stop this entirely? The biggest threat to BRICS monetary cooperation is internal division. If China and India have a serious military conflict over border disputes, cooperation becomes impossible. If political changes in Brazil or South Africa lead those countries away from BRICS alignment, the bloc loses critical mass. If Russia's economy completely collapses under the weight of sanctions and war costs, they can't meaningfully participate. The US and its allies aren't sitting idle either. There will be diplomatic pressure, economic incentives, and possibly economic consequences for countries that move away from dollar systems. This is a competition, and the US still has significant advantages. Technology could also play a disruptive role. Central bank digital currencies, which many countries are developing, could change the game entirely. If China's digital yuan becomes an effective tool for international settlement without needing gold backing, that might be a more viable path than a BRICS gold currency. Blockchain and distributed ledger technology might enable new forms of trade settlement that don't require a traditional currency at all. The financial technology landscape is evolving so rapidly that today's proposals might be obsolete before they're implemented. Climate change and energy transition could influence outcomes too. If the world moves aggressively away from fossil fuels, Russia's economic model collapses, fundamentally weakening BRICS. Conversely, if energy remains predominantly fossil fuel-based for decades, petrostates maintain leverage and motivation to move away from dollar pricing. The intersection of monetary policy, geopolitics, and energy markets is incredibly complex, and changes in one area ripple through others. Here's my honest assessment synthesizing everything. The BRICS gold-backed currency proposal represents a genuine challenge to dollar dominance, driven by real motivations and backed by countries with substantial economic power. However, the practical obstacles to implementation are enormous, and the probability of complete success is uncertain. What we're most likely to see is a hybrid outcome. Some version of BRICS trade settlement emerges. It captures a modest but significant share of international transactions. The dollar remains dominant, but shares space in a more multipolar monetary system, and precious metals gain renewed monetary relevance. This process unfolds over years, creating gradual shifts rather than dramatic overnight changes. For investors, this means precious metals deserve a place in portfolios. Diversification across assets and geographies makes sense, and staying informed while avoiding panic is essential. The worst mistake you could make is either ignoring this entirely and assuming nothing will change, or panicking and making extreme portfolio decisions based on worst-case scenarios. The reality will likely fall somewhere between those extremes. Build a balanced portfolio with some protection against dollar weakness through precious metals and hard assets. Maintain exposure to U.S. markets because they're still dominant and dynamic. Include international diversification, and stay flexible enough to adjust as the situation develops. This is one of those rare historical moments where the financial system that's defined global commerce for generations might be undergoing fundamental change. Not a collapse, not a revolution, but an evolution that could reshape how international trade works and where economic power resides. Whether the BRICS currency specifically succeeds or not, the underlying trend toward reduced dollar dominance and increased monetary multipolarity is real. Understanding that trend and positioning accordingly could be one of the most important financial decisions of the next decade. Keep watching, keep learning, stay balanced, and think long-term. The monetary world is shifting beneath our feet, and those who recognize it early and adapt thoughtfully will be best positioned for whatever comes next. Technology could also play a disruptive role. Central bank digital currencies, which many countries are developing, could change the game entirely. If China's digital yuan becomes an effective tool for international settlement without needing gold backing, that might be a more viable path than a BRICS gold currency. Blockchain and distributed ledger technology might enable new forms of trade settlement that don't require a traditional currency at all. The financial technology landscape is evolving so rapidly that today's proposals might be obsolete before they're implemented. Climate change and energy transition could influence outcomes too. If the world moves aggressively away from fossil fuels, Russia's economic model collapses, fundamentally weakening BRICS. Conversely, if energy remains predominantly fossil fuel-based for decades, petrostates maintain leverage and motivation to move away from dollar pricing. The intersection of monetary policy, geopolitics, and energy markets is incredibly complex, and changes in one area ripple through others. Here's my honest assessment synthesizing everything. The BRICS gold-backed currency proposal represents a genuine challenge to dollar dominance, driven by real motivations and backed by countries with substantial economic power. However, the practical obstacles to implementation are enormous, and the probability of complete success is uncertain. What we're most likely to see is a hybrid outcome. Some version of BRICS trade settlement emerges. It captures a modest but significant share of international transactions. The dollar remains dominant, but shares space in a more multipolar monetary system, and precious metals gain renewed monetary relevance. This process unfolds over years, creating gradual shifts rather than dramatic overnight changes. For investors, this means precious metals deserve a place in portfolios. Diversification across assets and geographies makes sense, and staying informed while avoiding panic is essential. The worst mistake you could make is either ignoring this entirely and assuming nothing will change, or panicking and making extreme portfolio decisions based on worst-case scenarios. The reality will likely fall somewhere between those extremes. Build a balanced portfolio with some protection against dollar weakness through precious metals and hard assets. Maintain exposure to U.S. markets because they're still dominant and dynamic. Include international diversification, and stay flexible enough to adjust as the situation develops. This is one of those rare historical moments where the financial system that's defined global commerce for generations might be undergoing fundamental change. Not a collapse, not a revolution, but an evolution that could reshape how international trade works and where economic power resides. Whether the BRICS currency specifically succeeds or not, the underlying trend toward reduced dollar dominance and increased monetary multipolarity is real. Understanding that trend and positioning accordingly could be one of the most important financial decisions of the next decade. Keep watching, keep learning, stay balanced, and think long-term. The monetary world is shifting beneath our feet, and those who recognize it early and adapt thoughtfully will be best positioned for whatever comes next.